So a lot to talk about. Daily chart, you can see a couple interesting things. One, we have a double top with basically the all-time high right here and the double top over here. So the way I look at it, if you want to keep it really, really simple, trading ranges are always forming double tops and double bottoms. We have a double top with the January 24th high and the February 19th high. We had a strong breakout and follow through. We broke below the neckline of February the 3rd, and now we're breaking below the neckline of January 13th. Probably going to bounce. The bear channel's good for the bears, but it's not as strong as it could be. This looks like a bear leg in a trading range. And therefore, if you think about it, we have a bull trend trading range, which means we have a trend line break and then a lower high major trend reversal. But so far, this looks like the trading range is continuing. And because of that, that makes me think that we probably will bounce and try and form a lower high. So what does this mean? This means that we'll probably get a couple of legs sideways to up. And therefore, as far as traders selling down here, really don't think it's all that ideal. So we'll probably get a bounce. I want to make a comment before I forget. Most interesting chart of the day. The winner goes to the euro versus the dollar. The dollar's gotten crushed over the past few days. And this is the daily chart. I thought we would go, so we had a spike, pull back to the December the 6th high. I thought we would at least reach that high. And then over here, I made the comment, we had a wedge, possible double top with these highs and this high. We had a decent bear breakout, followed by a follow-through bar here and here. And I thought that sell-off was at least strong enough that we would probably get a second leg down. So it probably would be sellers above and at least a small second leg. And then you can see, I believe this was Monday. On Monday, we had a really strong reversal and it trapped a lot of those traders who were selling. Strong enough bar, we'd probably get at least a little bit of follow through. And if you remember, this day right here actually rallied and started to pull back intra-bar. But it was a strong enough breakout that it trapped traders selling above Monday's high. Monday was the first bull bar right here. And then when this bar closed on its high, and the way I like to think about it is this. If you're a bear and you sold this high, what are you going to do when you see this? You're going to be panicking out of your shorts. Realistically, you sold this high, maybe you scaled in, and then you see the momentum to the upside. And this is a great lesson of why scaling in can be dangerous. If you can't recognize what a strong breakout is, now look at this. You're in a lot of trouble if you're short. And therefore, that makes me think that we're probably going to get at least a second leg to the upside. Targets, tested the November high over here. So this bear bar on November the 5th or the 6th, November the 6th. Yesterday, let me make these bars a little bigger. So yesterday, we sold off, broke below the January the 3rd, I believe it's January 3rd. Broke below the January 13th low, right here. And I thought the odds were it probably would bounce. So we sold off, we broke below it over here, and then we rallied. And because of that, I thought the rally was strong enough that we'd get an attempt at a second leg. And then the bears had a decent sell-off late in the day. But the sell-off was likely to form a trading range. So bar one, gap down, but it's a relatively small bull bar. I thought it was a strong enough. Let me say it like this. Let me first space these bars out a little bit more. There we go. I thought bar one was likely to get a second leg and would probably test up to the 81 close. 2, overlap with 1. That's a warning that this is probably going to be a trading range open. So really not a great buy the close 2, but we'll probably go a little bit higher, but I suspect sellers above. 3, a bull bar, but for the bulls, it's 2 legs up after the gap down. Rally on 1, pull back 2, rally 3, and a tail above 3 under the moving average. Plus the sell-off down to 77 was strong enough that the odds favor a second leg down and a test of the 77 low. And that's what bar 5 was, bar 4. Bar 4, first off, bar 1 has a relatively low probability of being the low of the day. Only 20% chance bar 1 is actually the low of the day. And then 5, we have follow through after 4, strong enough bear bar, probably going to get at least a small second leg down. So therefore, do you sell it? You have a big up, big down, big confusion. And just like we broke above 1 and found sellers, what do you think is going to happen if we break below 1? We're probably going to find buyers. 6, bear breakout, 3-bar micro channel, 4, 5, and 6. But do you see how the pattern is similar to 1, 2, and 3? Bar 1's a bull trend bar, and then 2 is an overlapping bar, 3 is a breakout. Bar 4 is a bear trend bar, bar 4 is a bear trend bar. Bar 5 has overlap with 4, so it's a pullback. It's a trend line break of bar 4. In other words, we sold off trend line break. Then we got a second leg down to bar 6 and a test of the 77 low. 6 is probably more of a buy the close bar than a sell the close bar. This looks like an expanding triangle type of open. 7, bull breakout bar, good for the bulls. But what do you notice? We have a high, we broke above 1, then we broke below 1, and then we broke above 3. So this is an expanding triangle. So as far as buying the close of 7, it's actually a little bit dangerous of a buy. And the reason for that is we may get a small second leg up above 7, but 7 has a big tail and it could reverse down and at least test the 6 high. The 6 high was a 4-bar micro channel, and that increases the chances that the market is going to get back down to the 6 high. And then 8, bull bar, but a small bar, probably sellers above. 9, we have a bear bar and a doji, probably buyers below, but we'll probably close the breakout point first. 10, bear breakout, strong enough bar, we may get a second leg down. Because it's a wedge, my concern is we could still fall below the 6 low. And then 11, 3 consecutive bear bars, but tail below 9, bear bar on 10, and then tail below 11. Probably buyers down here. 12, a smaller bear bar. Good for the bears that it's follow through, but we're losing momentum at the bottom of a trading range. That's not ideal. And just like the bears who sold above 6 and scaled in higher made money, I suspect the bulls who bought the 9 low and scaled in lower are going to make money. 13, reversal up. Good for the bulls, probably going to get at least a small second leg up. And then we got follow through buying, closing gaps. So clearly we're in a trading range every time. Limit order traders are making money, especially if they scale in. And stop order traders are, even if they make a little bit of profit, it's retesting their entry price. 15, we reverse down below 14. So right now, what's the one thing we know? Break trend bars are getting bad follow through. 16 consecutive bear bars, middle of the trading range, low probability to sell below the bar, low probability buy above the bar. And then 17, we have a bull bar closing on its high. It's a triangle, and therefore you can buy above 17, stop below 17. Betting on a Walmart trade and taking a chance that we get an upside breakout in a test of yesterday's 71, which is certainly possible. We had to buy the close bar, it never got retested. Theoretically, bulls buy, they buy more lower, they make money. Or they at least get out break even. 18, reversal bar, probably buyers below scaling and lower. But you'll have some bears, just like the bulls who bought above 17, you'll have some bears sell below 18, stop above 18, taking a chance that the market is going to go lower. Not a good follow through bar, 19, so probably buyers below. And then 20, we have a bear bar, but a tail below 19 and then a tail below 20. Looks more like trading range price action. Are we always in short? Theoretically, we're always in short, maybe below 18, but always in a trading range. By the time it's clearly always in short, normally the market reverses. So as far as selling the 20 close or being short on 20, I really don't think it's all that ideal. And then 21, we broke below all the bars to the left. We got a second leg down after 77 from yesterday. Good for the bears, but why aren't the bodies getting bigger? It looks like more traders bought below the 6 low of today and yesterday's 77 low than sold it. Inside bar 22, low 1 short, but a low 1 short at the bottom of a trading range often finds buyers below it. So buyers below, and we may bounce. Bull bar 23, second entry buy, but a micro channel from 18. It's a low probability buy, but low probability buys, think about it, in general, when you're in a trend, 60% chance it's going to continue to go in the trending direction, 40% chance that you're going to get a successful reversal. That's not exactly true, but it's basically the 40-60 rule. And then if you think about it like this, basically what I'm saying is this: generally in a trend, buying above a bar like 23 would be low probability. However, in a situation like this, and it'd be low probability because it's a micro channel from the 18 high. However, in a situation like this, because you're in a trading range, buying above that bar 23 is actually higher probability than it looks. Lower probability is higher probability. And what appears higher probability, selling above the first pullback in a micro channel, is lower probability. In other words, everything gets squeezed closer to 50%. 24, Doji, not a lot of traders. Traders who sold below 22, disappointed 23, getting out break even 24. Probably going to bounce here. And then 25, we got a second leg down. We went below 21, but do you really want to sell down here? Probably not. Even if we go a little bit lower, I suspect buyers below scaling in. And then a bull bar 26, but a tail above the bar, tight trading range, not ideal. And then we got a second leg down 27. Looks like we have a spike and then channels evolve into trading ranges. So I suspect we're probably not going a lot lower. Bull bar 28, as far as buying above it. Bulls haven't made money in quite a few bars. Buying above 28, it's not a great buy signal bar. It's arguably a wedge, maybe 21, 25, 27, but really not ideal. And then we got a second entry with not really a second entry, but basically a micro double bottom, 28, 29, improves the probability for the bulls, but it's still not yet high probability. And then 30, bull breakout, good for the bulls, backed always in long. The odds are typically, and if you buy anywhere in here, you buy above 17. In a trading range, it's fairly common. If you buy above 17 and you don't panic below, let's say 18, 19, and 20, and use a wide stop and scale in, it's pretty common to be able to buy. Pick a number, 80% chance you buy more lower, you're going to at least be able to avoid a loss. 60% chance you can get out break even at your first entry. So some bulls, they bought the 17 high, they bought more lower, and then some getting out break even at their first, profit on their second. Others will look at 30 and say, this is a trading range. We had a triangle and called a final flag. We broke to the downside. Now we're reversing up. We may try and do the opposite and try and go somewhere up here. Tail on 30, but crossing the moving average, probably going higher. Tail 31, but I suspect buyers below and scaling in lower. And then you can see we formed a relatively tight channel. Why do we form a tight channel? Because a lot of traders are not going to be interested in selling right here when they just got trapped at the moving average. So strong rally, always in long. Is it buy the close 35, buy the close 36? It probably is, especially if you're willing to use a wide stop and scale in. And then the body's getting smaller, probably will pull back soon. But what about selling? Well, look at the market. Where would you sell on a stop below a bar? The answer is nowhere. You're not going to sell below 33. You're not going to sell below 37 or 38, and therefore it's buyers below scaling and lower. 39, still buyers below scaling and lower. And you can see pullback was deep, but what's the chances we go above the 39 high? Relatively high. Second leg up on 41, good for the bulls. But now traders are starting to buy pullbacks. And what's that going to do to the rally? Well, it's going to increase the chances that every new high is going to get sold for a pullback and traders will buy lower. So as far as buying the close of 41 with the tail above the bar, it's probably better to buy a pullback or buy breakout points. 42, follow through buying, good for the bulls. Traders will buy the close and scale in lower, but other traders, I think it's certainly reasonable just to look to buy lower. Doji 43, so losing momentum, so may pull back soon. And look what happened. Really big bear bar closing on its low. With that bear bar, it's easy to look at that bar and say, oh my gosh, that's a big bear bar. That's going to be the start of 72 from yesterday. And we're going to get this large sell-off. But one bear bar is often not enough. There's another issue with this bar. This bar is actually forcing traders to sell in the buy zone of a trading range. We have a bull rally, so think of it as a bull trending behavior, and then trends often evolve into trading ranges, and then so the market, you go from bull trend to trading range down to bear trend. So if you want to think about that in numbers, easy way to think about it is 1 is a bull trend, 0 is a trading range, and -1 is a bear trend. So +1, we're trending behavior. This sell-off takes the market from +1 to 0, which is trading range behavior. And then the market's got to go lower to get -1, which is bear trending behavior. I talked about that in the Brooks in the trading room. So the Brooks, most of you know what the trading room is, but the Brooks Trading Course trading room, I talked about that yesterday during the session. So if you're a subscriber, just go to the recording and you can check out that conversation about about +1, 0, and -1 analogy explaining the market cycle in terms of numbers. But anyways, this is more likely a trading range. Strong enough breakout, you're likely to get a second leg down. So there will be traders buying it. But you also have bulls who bought, scaled in, and they're trapped, and they'll use the bounce to get out break even, expecting at least a small second leg down. 45, do you buy it, sell it? There's realistically probably really more sellers above the bar. But my concern here is even if there's sellers above 45, the downside's probably limited because we're probably going to go above the 42, 43, or 44 high. Bull bar 46, good for the bulls, but not a lot of follow through. And they're hopeful that 44 is a trap. So something like this, big bear bar 60, follow through 61. And instead of the bears getting a second leg down, they get trapped into a reversal up. In other words, they want a bull breakout of a bear flag. We have a bear breakout, pull back 45, it's a bear flag. The bulls want a bull breakout of the bull flag. Excuse me, of the bear flag. 46, 47, body's getting smaller, but a bad looking low one, probably buyers below. And then 48, we triggered the low one, but that's not that great of an entry bar. Plus, it's right at the moving average, and this may cause bulls to start buying. And then 49, no surprise, we went below the 46 close, allowing the sell the close bears who sold the close of 46 and more higher to make money, but probably going to bounce here. And that's what happened with 40, set with 48. 48, second entry buy, bull bar closing on its high. Bulls who bought up here and didn't panic and bought more lower, they're probably going to make money. 51, bear bar closing on its low. You can call it a triangle, but I suspect there's probably buyers below 51. We're probably going to try and get a reversal up. And then no surprise, 52, not a good buy signal bar above 51. Big bull bar closing on its high, breaking out of the tight trading range, probably going to go higher and probably try and get above the 44 high. And then follow through 53, good for the bulls. Is it by the close? I don't know if it's by the close, but it's a problem for the bears. And bears that are selling here, the bulls who bought here and bought more lower, they're deciding, do they get out break even? Do they get out? Do they get out break even at their first, profit on their second? Do they hold their entire position and add to their position betting on an upside breakout? Or do they panic? And it doesn't look like bulls are necessarily panicking here. It looks like the bulls want to see if the market's going to go higher. And 54 gave us that answer. Traders started buying and we broke above the 44 high. 54, good for the bulls, probably going at least a little bit higher. 55, follow through buying. But you can see 55, it pulled 55, the open at 55 pulled back to the bottom third of 54. And that's in a warning that traders are not aggressively buying. They're buying, let me say it differently, they're buying on the way up, but they're buying small pullbacks before the bar goes up. So as far as buying the close at 55 or selling it, I wouldn't sell it because it's a micro channel and it's fairly strong. But that's a warning that instead of buying the close at 55, traders will start to buy pullbacks of bars. And instead, 56, we have a strong bull bar. For the bulls, is it buy the close? It is buy the close. Climactic bar, so traders will buy and scale in lower. But either way, and with that size of a bar, it's probably more of a profit-taking bar. Risk is getting big. I mean, what do? The reality is when you look at this, you're not going to sell. And therefore, the question is, do you buy and scale in lower? Or do you, in other words, do you buy and hold through the pullback and add on? Or do you try and buy, or do you wait for the pullback and look to buy? But if you wait, you risk missing the trade. We're so close to this high up here that I suspect we'll probably get there or at least get closer. And then Doji 57. So the bulls aggressively buying 54, 55, 56. They'll look at 57 and say, something's not right for the bulls. Big bull bar 56 and then weak follow through 57. Looks like we'll probably find profit taking soon. And you can see what happened. 58, we reversed down. Probably outside down might be strong enough for a small second leg, meaning if 59 is a bull bar, which it is, there might be sellers above it. But 59 is a pretty strong bull bar. And the reality is, when you see a bar like 58 in a tight bull channel from the 52 low, there's going to be buyers below it. So we're probably going to go above the 58 high to minimum. And I suspect we're going to get up to that red line. Bear bar 60, we had high one by 59, typically leads to high ones typically have sellers above. They pull back and then get trend resumption. Now, what about 60? Do you buy 60? 60, it's okay for traders to look to take profits below 60. It's a second entry. But, realistically, as far as selling it, I'd rather wait and see a strong bear breakout. And the reason is too much risk we form a tight trading range. bulls, they were able to prevent the bears from triggering the sell in 60. That's good for the bulls. And then it got a small second leg down on 62. 62, second leg down after 60. Probably more buyers down here than sellers. And then you can see we started to go sideways for several bars. And look what happened. We got a bull bar 64, doji, and then outside down 66. That's because traders were buying up here and then taking partial profit. 66, second entry sell after two large legs up with a lot of trading range price action over here. Increases the odds that we may have to pull back to the moving average. And then look what happened. Instead of triggering the sell below 66, the market failed to trigger the sell and we broke to the upside. We got follow through buying 67, 68. We're so close to the red line. I think we'll get there. And a bull bar 69. And the bulls, they just couldn't quite do it. And then with 68 and 69, bodies getting smaller if we broke to the downside. But breaking to the downside is kind of like bar 44. Good bar for the bears, but it's enough to make it a trading range. But I do not think it's going to make it a bear trend. And you can see what happened. We basically went sideways for the rest of the session. For stop entries, you can buy above 1, but I don't think it's great. Low probability. And then generally, for me, I think one of the best rules traders can have, especially when they're starting out, is just don't trade the first 6 to 12 bars. Wait for a clear stop entry. And the reason why you don't trade for the first 6 to 12 bars is most of the time the market has to form some variation of a double top and a double bottom. In other words, the market has to form a trading range. 18 was the first reasonable sell. You can buy above 17, stop below 17, or you can sell below 18. Not clear if it's always in long, always in short, and probably always in short. 19 and 20 if you had to pick a direction, but still low probability. And then here, I think it's tough to sell. If you are short, you get out of, I would definitely get out of shorts above 23, certainly 28 or 29. Aggressive bulls will buy, or maybe they buy the high 132, or they start buying bull closes. And then when you see the pullback on 40, that's a warning that whatever rally we get is probably going to get sold and we'll probably pull back again. But in any event, maybe always in traders get out a couple of points below 43 and then look to buy again, maybe above 50. Or they can wait and buy the breakout 52 or the follow through 53. And then up here, not really any good trades to sell. Maybe you get out below 60, but really tough overall. If you get out below 60 and then you buy again above 64 and you get out below 66, that's an easy way to really get chewed up because it's a tight trading range. For limit orders, lots of limit order trades. Sellers above 2 and sellers at the close of yesterday's 81. Buyers below 1, scaling and lower. Sellers above 6, but that's more of a buy zone. It's better to look to sell in the upper portion of the range. 9, 3 legs up, so don't buy the low of 9. Buy more lower. And then down here, I thought buyers below, and then I thought buyers below 39. That was reasonable. Sellers above 43, probably okay, but tough to do. And then I thought buyers below 48, buyers below 45, anywhere around the moving average, and then buyers below 57 for a scalp. And then lots of limit order trades here, but I'm not going to go into all of them. Buy the close, sell the close, maybe 20, but not really all that great of an environment. And then probably buy the close 35, 36, 37, 38 for a second leg. Then arguably buy the close, maybe 54, 55, 56. I'm going to take a look at one or two questions, and then I got to wrap this up. Why is 59? Why 51 is a high 1? It still doesn't exceed the high of the previous bar. So why is 59 a high 1? Well, 59, that's a high 1's a retest of an extreme. So in other words, a high 1 is basically the market rallied and the market pulled back 58. Now it's retesting the extreme. Traditionally speaking, price did not go above the 59 high, and therefore technically it's not a high 1. But the reality is any high 1 is a retest of the extreme for the bulls. Any low 1 is a retest of the extreme for the bears. Okay, question. If you buy the close at 54, where would you place your stop loss? So if you buy the close at 54, where's your stop go? You can put it below 51 or 52, but that risk is big. For me, if I'm buying a breakout, I'm probably going to put it below, maybe 53. But the reality is I'm going to actively manage the trade. So the point is when you're buying a breakout, use a wide stop, but you have to have a premise for understanding what the expectation behind the trade is. which is better for bigger, Emini or Forex? I'm not sure what you mean by bigger, but unless you have more money than, extremely large banks, then you're not going to have an issue. So the point is, I wouldn't worry about that question. What I'd really what I'd ask the person answering this question is, which one is more suitable for a trader starting out? The risk can be big with the E-mini, even with micros. Some of these bars are 30 points, and 30 points, that's $150 for one E-mini, and therefore for one E-mini, it's $1,500, and that's a lot of risk. Forex, great market to pick, especially when you're starting out, though. All right, so that is all the time I have. I appreciate everybody taking the time to listen, and I hope everyone has a great rest of their day. Talk to everybody soon.